Thank you for the opportunity, Dave. I appreciate it. Pardon the voice. It's allergy season here in California. Today we're going to talk about what was advertised plus some more stuff. The good news is this. I have nothing to sell you. I have no offer for you. I have no fancy stuff. I have no courses to teach you. All I have is information that I've gathered as a trader for over half a century, and I'm beginning to sound like it as well. So let's talk about today first. And Dave, I've got what, 38 minutes, 35 minutes?
You have 37 minutes right now.
Thank you very much, Dave. So one of the things that I've learned in my many years of trading is this. The more colors, the more lines, the more special indicators you have on your chart, the more likely you are to lose money. Just my opinion. My trading is simple, it's clear, it's direct, it's completely rules-based. There's no interpretation, there's no thinking, there's no 100 indicators, there's just specifics and clarity. That's all we do. So I'm going to show you the Commitment of Traders report shortly, but right now I want to talk to you about something else. One of the best books that was ever written, and by the way, there is a risk of loss in trading. One of the best books ever written about trading was written by a man named Art Merrill. I'm going to show you what he said in his book. And if you can get that book, it's a classic and definitely worth having in your library. But before we begin, let me give you something absolutely precious. It's the trading model. If you're not trading with a specific trading model, including this one, setup, trigger, follow through, you're going to lose money if you're not already losing money. What do I mean by that? Let me talk to you about the parts of this model. Part number one is the setup. Every trade needs a setup. A setup is a pattern. Example, Elliott wave is a pattern. Fibonacci is a pattern. Support is a pattern. Head and shoulders is a pattern. Reversal, key reversal, flags, pennants, windows, blah, blah, blah. These are all patterns. The good news is there are literally hundreds of patterns. The bad news is there are literally hundreds of patterns, and most of them don't work. They have no predictive validity. How do we know that? We've got computers. We can take a pattern and define it algorithmically. In other words, if this, then that. Put the algorithm on a computer, which we can do faster than ever now with artificial intelligence, and within a matter of seconds, have an answer. Does this pattern predict anything? The good news, as I said before, there are literally hundreds of patterns. The bad news, most of them predict nothing. A pattern needs a trigger. So if you find a pattern that has had good probability of success, that pattern has to trigger, by which I mean, example. Let's say we have a pattern that's been right 77% of the time in the last 50 years, which most people don't even know how to get that information, but it's easy to get. If that pattern is going to repeat this time, it's going to be wrong from 73% of the time it's been right, then it's been wrong about 27% of the time. We want to avoid that 27% and increase the probability of success this time. So we use a trigger, which most people call timing. Setup and trigger. Once you have a setup and a trigger, I'm going to show you some today. You get follow through, which consists of three parts. Number one, where is your stop? Where are you going to be wrong? Number two, what is your first target? That first target, once attained, will keep you out of trouble because you'll take some money off the table and place your stops at break even and let the damn trade go. Number three part of this is this, profit maximizing strategy. How do you turn the $450 profit into a $4,500 profit? There's specific ways of doing that. So the good news is this, most traders have really reasonably good timing. They have good intuition or they have good trading skills. Number two, the problem is this. Most traders take the money and run. They're always going for the small trade, the little trade, the trade that gets them out of danger. They take all the money off the table, and then when they see the trade go really big over the next few days, they're wondering, why didn't I have a piece of this? The answer, because you didn't have the setup, trigger, follow through model. You didn't put your work into that model so that it could tell you how to maximize your profit. As an example, here's a chart. This is a long-term chart of Japanese yen versus US dollar. You can see it's a cycles chart. The cycles are very symmetrical. They're not perfect. They bottom out roughly at about the right time. And so it was very easy for me to take this cyclical pattern and say, this is my setup. Now I need part 2, which is a trigger. So in an article that I wrote about probably 6 or 7 weeks ago for the Foundation for the Study of Cycles magazine, I indicated that we were in the right time frame for a bottom in the Japanese yen. We needed a trigger. We moved to a trigger chart, which is right over here. We marked the trigger over here, and from that point forward, the move occurred. Now this move is far from over because it's a long-term chart, but I'll talk about that more if Dave invites me back sometime. Let me show you another one. The very, very accurate cycle in Treasury bond futures. Quite amazing. As you can see, it's not perfect from low to low, but it did forecast a low here correctly, and it did forecast a low here recently. And so this cycle, which is roughly 2014 to 2019, about a 5-year cycle, has been very effective in picking these big moves. The good news is that there are big moves and they're reasonably repetitive. The bad news is most people can't have the patience to sit with these for the big move. So what does this mean? In the big picture, in my work, this is a setup. I'm waiting for a trigger. Has the trigger occurred? It has. And that ability of the trigger to occur at the right time puts us into step number 3. We did take the trigger on part number 2, which I'll show you momentarily. So this is a setup. It's very pretty. It's good to look at, but what does it mean? In terms of what it means, very simple. This is Treasury bond futures. As bond futures go down, interest rates are going up. So if we made a bottom in the cycle right over here, over the next few years, we should see interest rate futures go up, which means interest rates go down. It's an economic forecast. All they'd have to use is this chart, and they wouldn't need economists. This chart can do a better job. So what happened? Let me show you. We moved to the trigger right over here. Let me get the next slide for you. And here was the chart. And all the way down, let me go back one step here. We wanted to time this top. We wanted to take this pattern and time it with a signal. And that signal occurred right over here at the top of the move. We got a sell signal that's been down ever since. Recently, we got a buy trigger as well. We don't have time to show you all that. So what's next? Let's take a look. Set up, trigger, and follow through. If there's one thing that I could teach you better and more importantly than anything else I can show you, it is what I just showed you now. Set up, trigger, or follow through. I want you to think about this because remember, I've only been trading for half a century. I might be able to teach you something. The bottom line is this. If you don't have setup, trigger, and follow through, you're not going to know exactly what you're doing, when to do it, or what you did right or what you did wrong. You need to learn from what you did right. You need to learn from what you did wrong. But if you don't have a structure in which to put all your information, it's never going to work for you. So what else do we need to do? Let me show you something else. Hold on a moment, please. We're going to talk about pre-holiday seasonals, and then briefly we'll switch to the COT. Pre-holiday seasonals. One of the best books ever written about trading was written by a man named Art Merrill, entitled The Behavior of Prices on Wall Street. It's a classic book. It's out of print, of course, so now it's selling for about $300. It's worth owning and holding in your library. You're going to learn a lot from this book. The bottom line is this. What Merrill did was classic. He did research. And even though it was the 1950s, he knew how to do research. He traced specific behaviors in the markets, in the Dow Jones average, back to the late 1800s and developed some statistics and gave them to us so that we could use them in our trading. Let me give you an example. One of the things that Art Merrill studied was pre-holiday behavior. In other words, if we look at all the legal US holidays, he noticed that on the day before a legal US holiday, the Dow Jones tended to close higher. Example, let's talk about Thanksgiving. We know that Thanksgiving, one moment please. Be right back, guys. We know that Thanksgiving is the last Thursday in November. So if Thanksgiving is the last Thursday in November, and by the way, please notice, everything I'm telling you is algorithmic. It's not interpretive. I don't have to look at 14 different indicators with different colors and different arrows. I just have to know the rule. The rule that I'm going to give you is very specific and clear. It's not perfect, but it is very effective, and it tests out statistically over many, many years. So let's go back to November. Thanksgiving is the legal U.S. holiday, and it occurs on the last Thursday of November. So if Thanksgiving occurs on the last Thursday of November, and we know what the rule is, we buy on the close of trading Tuesday, get out on the close of trading Wednesday, because Wednesday is the day before Thanksgiving. It's a very simple rule. Merrill talked about this rule on pre-holiday behavior. And by the way, the pre-holiday trades this year, as far as I can recall, every single one of them has been correct. And the nice thing about it for many people is it's strictly a one-night stand. It's done with the next day, which is what makes people happy these days. I'm not sure why. And even though I wrote the 5 best-selling books on day trading from McGraw-Hill, I'm not particularly interested in day trading anymore because it's become highly competitive. So we're not going to talk about day trading, even though I can teach it well and I can do it well. It doesn't interest me because remember, the most important thing for you and for me is time. You can't buy time. And the problem is this. When people trade for day trades, they make a few $100s, they get out. They start again the next day. The problem is when they take a loss, it'll be sometimes 5 or 6 times bigger than their average profit per trade. So there's no way to maximize a profitable day trade because you're out at the end of the day. The only way to maximize a profitable day trade is with a large position. If you trade a large position and you're making good money on accuracy with the day trade, it'll work for you. But here's the problem. Most people can't afford a large position, and even those people who can afford a large position, excuse me, even people who can afford a large position allow that position to scare them. So they sit in front of the machine all day long with a large position and make mistakes because of emotional decisions. Let's get back to the behavior of prices on Wall Street. So Art Merrill's work was brilliant, and he proved statistically that this kind of behavior, in other words, about 73% accuracy prior to major US holidays, has not been achievable except by real statistics. In other words, this kind of behavior can only happen once in 10,000 times. So let's take a look. I'll show you. Here we go. Here is a list, excuse me, here is a list of holidays in the United States for 2024. Let's take a look. New Year's Day. Even though Martin Luther King's birthday is a holiday legally, unfortunately, there is not enough history behind it to take a trade. Maybe in another 10 years we'll have enough history, so we don't trade that one. We have Washington's birthday. We have Memorial Day. We have Juneteenth. Same situation as Martin Luther King's birthday. We're not trying to discriminate against anyone. We're simply saying there's not enough history and we need a vast amount of history. We've got July the 4th. We've got Labor Day. We've got Columbus Day, Veterans Day, Thanksgiving Day, and Christmas Day. These are all tradable days based on the rule. So what's coming up? Columbus Day is coming up. Yes, ma'am. Columbus Day. Columbus Day is the second Monday in October. So that's coming right up. So what's the rule going to be? Because the holiday is on Monday, the 14th of October, we buy the end of the day Thursday, get out the end of the day Friday, and that's the Columbus Day trade. Now, the rule is very specific. It says that your risk is going to be the largest range day of the previous 10, and your profit target will be you're out at the end of the day Friday. Let's see how it works. Let's take a look at something else. Here is the same trade here's the July 4th trade last year. Where's the July 4th trade? It's this one right over here, July the 4th. So let's take a look at what happened. Here's the trade. And this over here is July the 4th, over here. This is the entry date, end of day Wednesday. Get out end of day Thursday, get out end of day Friday. And this is July the 4th. So what happens? We're buyers here, we're out over here. That's all there is to it. If you want to maximize the profits, you can certainly do that. If you want to trade it with options, you can certainly do that, but they need to be options that are at or close to the money. Let's take a look at another chart. Here is the next chart. Just one moment, please. Here is the pre-holiday trade for last year for Columbus Day. So this was Columbus Day right over here, the vertical green line. Come on, computer. This was a buy right over here at the end of the day, out at the end of the next day. So there it was. That was a Monday. This was a Friday. This was a Thursday. It couldn't be more simple. We don't need all kinds of colors and arrows on the chart. It's absolutely incredibly simple. Not perfect. So how can you protect yourself? Easy. It's a beautiful trade for an option at or close to the money. So think about that. It's not a recommendation. It's just a study of history that I'm giving you. Let's see what happens. Let me show you something else. So here's a rule. You would say Thanksgiving Day. The rules are very clear. They're stated specifically when to get in, when to get out, the percentage accuracy, and so forth. So I'm a numbers guy. I want to see the numbers behind everything that I'm doing. Super important. Let me show you a few more things. Let's take a look at the behavior of the S&P from now until the end of the year. What have I done here? I've taken every December S&P contract all the way back to the start of trading in 1982, and I've turned it into one chart. We've normalized the data. We took each year and made the high of the year 100, we made the low of the year 0, so that no 1 year or 2 years or 5 years can interfere with the pure seasonal trend. So let's take a look. We've got numbers in the boxes. The numbers in the boxes are the percentage of time up or down. The number in the box with an arrow up in green means this is an up week. And what I'm looking for is I'm looking for what I call a seasonal run. I want to see the market running in the upward direction with arrows up or in the downward direction with arrows down. These are the high probability trades. So let's situate ourselves right here. Here we are, the 9th of October. So that puts us right about here. What's coming? Look at the chart. It's not perfect, but it gives us very strong odds of a big move to the upside. We want to zero in on this move and see what happens this year in terms of timing. So with respect to the strategy that I laid out for you, setup, trigger, follow through, what is this? It's a setup waiting for a trigger. Typically, this move here between mid-October to the end of the year is often not only the most predictable move of the year, but also frequently the biggest move of the year. So that's what's waiting for us. How do we do it? How do we find these more specifically? We can search this for an ideal entry. So I go to a seasonal website, which I own, seasonaltrader.com, and I do a search. I say to the computer, zoom in on S&P 500 futures for the month of October and give me everything that you have in terms of probabilities. So let me show you this. It's truly fascinating. Computer gives me this. It says that if I bought December S&P futures end of day October the 27th, got out end of day November the 6th, the short-term trade with a 3% stop close only, my profit to loss ratio would be 17.6 to 1. My accuracy would be approaching 89% over an extended period of time. Now, this is the kind of information that you need as a trader. If you don't have access to this kind of information, it's never going to work for you. You're always going to be behind the eight ball trying to interpret, trying to understand different indicators, looking at seasonals, looking at cycles, looking at timing, looking at everything. This is a very narrow, specific approach that gives us all the information we need, day by day by day, specifically to the entry. Is it guaranteed? Of course not. It's only 88% in this case. And what we can do is we can go back and look at history and ask the question, did the history conform to what we expect? Now, if you look down this list, you say, why are there so many of these? Well, you have different choices. I chose the one with the highest accuracy and the largest percent win, largest point win. You can make your choices by deciding, I'm interested in the largest win, largest average profit. I'm interested in the smallest stop. So it gives us choices, and fortunately, with the ability of computer technology and AI, we can do this very quickly. This gives the shows the track record. Again, this was year by year showing the results, and you can see the last trade over here in 2023 was the biggest one in history. Truly amazing. Can it repeat? Well, we don't guarantee the future. You can only look at the past and use it as a guide within the program setup, trigger, follow through to determine what we want to do. Let's take a look at another one. Here is the best trade of the entire year, going back over 50 years. In fact, I think it's going back more than 50 years. I think we go back 80 years. Buying the S&P or equivalent, end of day October the 26th, getting out end of day January the 16th has been right 85% of the time. No guarantees that it's going to be right again, but I want you to see the difference between what we're doing here and what is normally done in this business. We're actually looking at the numbers and asking the question, exactly when to get in, exactly when to get out, the average profit per trade, the stop, the risk, everything you need. And yet, most people who are aware of this don't use it. Why? Because as soon as they make a few $100s, they jump out quickly and they miss the big trade. Now, let me show you one more thing. Speaking of big trades, let's take a look at something else. We're going to look here at 120 years of copper prices. That's right, 120 years. Most people in this business don't even want to look 120 days. So we have a family of curves. In other words, the green line is the 51-year line. The red line over here is the 26-year line. So what we've done is we split the data up into segments to show how the different segments correlate with each other over time. And you can see that no matter what time frame we have, going back over 100 years, most of the activity comes down to this September, October in terms of the low. So right now in this little window right over here, we're looking for a major low in copper prices. So with respect to what I taught you, set up, trigger, and follow through. And by the way, if I'm going too fast, sorry. I have a lot of information to give you, and I hope you're enjoying it. I hope you benefit from it. So what are we doing now? Setup, trigger, follow through. This is a setup, and it says sometime in September, October, November, we will get a bottom in copper, but we need a trigger. The trigger is very easy. There are many different timing triggers. We can split the data up in other ways as well. And when you split it up that way, we see that November is a key area for a bottom in copper prices. The good news is you don't need to be a futures trader to trade copper. You've got SCCO, you've got FCOX, COPX, you got CPER, you got Rio Tinto, you got, there's a couple of others, FCX, I think I mentioned anyway. There's a whole bunch of them that you can trade as proxies for copper futures. Let's do something else. And here, by the way, is our timing trigger on copper, showing that copper has topped and we're waiting for a bottom. The top was almost perfect in terms of timing. Now we're waiting for a low. I'm going to switch screens, and I hope this works. I want to show you the commitment of traders. One moment, please. So what you should see now is a chart. And what you should see now is a commitment of traders chart. Let me explain that to you. Here we go. 1 second, please. I'm going to change charts. And I'm going to make one small change on my chart right over here. Just bear with me. Here we go. Just hang on, please. Okay. One moment, please. Hang on a second, please. We'll be right with you. I just have to get the right chart. Don't go away. Okay. I will have that for you momentarily, folks. The COT is a very powerful indicator. It's released every week by the Commodity Futures Trading Commission, and it gives us information on what traders are doing in terms of their positions. So for example, we're almost there, guys. Very close. Here we go. Okay, so the Commitment of Traders report divides traders into 3 basic categories: small speculators, large speculators, and commercials. Commercials are the individuals or enterprises that actually use this stuff. They use the corn. They buy the corn, they sell the corn, they're brokers that deal in the raw commodity. So if we know that they have a big long position, it's for a reason. They expect the price to go up. So looking at this chart, this happens to be a corn chart. And don't worry that if you don't trade corn, you can always trade the DBA, which is a agriculture ETF. So this is valuable information. So let me show you what I'm talking about. The green shows net commercial long positions, which means that the largest traders in the business are long the market. Notice what happens. Every time they've gone long the market, a move up has followed. Here, big move. Here, here, here. Every single one of these has been followed by a move in the upward direction. And by the way, because this is futures, these are really big moves dollar-wise. Look at the chart right now. What's happening? Commercials have been buying corn, net long positions, since all the way back here, and now own the largest amount of corn they've had in a long time. Do you think they're doing it for their health? No, they're doing it to make a profit. So this is a setup that points to a huge move coming in the corn market. What do we need now? A timing trigger that says the move has started. Let me show you one that you might be able to relate to a little bit better. Check this one out. Here we go. S&P. Now check this out. Here, before one of the biggest moves in history, commercial traders started buying corn started buying S&P right over here, and continued buying all the way to here. The same thing happened here, the same thing happened here, and here, and even though these were smaller moves, they were still right ahead of time. Does it mean anything that they have stopped buying? No, it means they're happy with their position. If they were to start buying again, this would be tremendously bullish, and that's S&P. Let me show you a market in which the commercials are doing some heavy buying right now. That's the IWM. Let me show you the Russell. Here's the Russell. And what are commercials doing? Check it out. They started buying right over here, and they're continuing to this very day with their long positions. As I said before, remember, they can, hold on one second. They can dollar cost average all the way down because they're playing with OPM, other people's money. So look at this. They kept on buying all the way down, buying all the way up. So their average cost is somewhere in the middle over here. They're already making money. The question is, will it continue? And notice this, right over here. Buying over here before this small up move, and buying over here before this big up move. Again, COT commercials. What's the current situation with your, Dave, will you let me know when I'm out of time? What's the current situation with regard to gold and silver? Well, they're not buying any right now, but I want you to see a market that they are buying. Here you go. Copper. Look at what commercials have been doing. They bought copper before this big up move here. They bought copper all along over here before this move over here. And now they've been buying copper as well in anticipation of higher prices. Let me show you one more, and then we will be done with our presentation. One moment, please. Let's take a look at soybeans. Here's soybeans, and check it out. Notice what they were doing for several years before this gigantic move up. What are they doing now? The same thing they did over here. In fact, they have larger long positions now than they ever had before. So that's what I have to show you today. It's very specific, it's very clear. I have nothing to sell you. If you're interested in what I'm doing, you can go to my website, jakebernstein.com. Thank you, Dave, for the opportunity, and I hope I haven't spoken too fast for you guys. Thank you very much.